What if the world's safest investment suddenly wasn't safe at all? The $9.2 trillion in U.S. Treasury debt isn't just government borrowing. It anchors banks, corporations, and your personal finances. And if confidence in these bonds fails, the consequences could ripple across the globe. In this video, we break down why U.S. Treasury debt is considered risk-free, and why that label can be misleading. How banks, pension funds, and corporations rely on treasuries to survive. What rising interest rates, inflation, and liquidity risks really mean for the global financial system. How this invisible $9.2 trillion affects your loans, retirement, job stability, and daily life. What could happen if treasuries fail, spreading shockwaves through the U.S. and international markets? Even if you've never invested in bonds, U.S. Treasury debt impacts every dollar you spend, every loan you take, and every financial decision you make. This is the invisible force behind the global economy, and understanding it is essential if you want to stay financially aware in 2026 and beyond. Watch till the end to understand why confidence in U.S. Treasuries is the single most important factor keeping the global economy from collapse, and what could happen if it cracks. Welcome to the Street Smart Secrets, your trusted source for practical, powerful, and easy-to-understand financial wisdom. There is a number that decides whether banks survive or collapse. A number that quietly determines how expensive your loans are, how strong your currency is, and how safe your savings really are. It doesn't trend on social media. It doesn't make headlines like wars or elections. Yet without it, the modern financial system would stop functioning within days. That number is $9.2 trillion. Not Bitcoin, not gold, not the stock market, but U.S. Treasury debt. And if you don't understand what this number represents, then no matter how hard you work, you are playing a game whose rules you don't know. The dollar that rules the world. In one of our previous videos, we discussed the top 10 currencies that rule the world. Out of all of them, the euro, the pound, the yen, the yuan, the US dollar ranked number 1. Why? Not because America has no debt, not because its economy is flawless, but because the dollar is the world's settlement currency. Oil is priced in dollars. Global trade is settled in dollars. International debt is denominated in dollars. Central banks store dollars. This gives the United States something no other country has ever fully controlled: monetary gravity. But here's the part most people miss. The dollar's power does not come from paper money. It comes from U.S. Treasury debt. U.S. Treasury debt is what happens when the most powerful government on earth spends more than it collects. To cover that gap, the United States issues Treasury bills, notes, and bonds. Promises to pay back money in the future. And these promises aren't bought by ordinary people alone. They are held by banks, pension funds, insurance companies, corporations, the Federal Reserve, and even foreign governments. Why? Because this debt is issued in U.S. dollars, the world's primary reserve currency. That single fact turns Treasury debt into something far bigger than government borrowing. It becomes the safest place to park money, the collateral behind trillions in loans, and the measuring stick that determines the price of money across the entire global economy. And the implications are enormous. The interest rates on U.S. Treasuries quietly decide how expensive your mortgage is, whether businesses expand or freeze hiring, and how fast economies grow or slow down. As the debt grows, interest payments rise, government choices become more limited, and the risk of inflation increases if the system is mismanaged. At the same time, because the entire world depends on U.S. Treasuries for stability, the United States holds unmatched financial power. But with it comes global vulnerability. When confidence in Treasury debt is strong, markets stay calm. When that confidence cracks, the shockwaves travel everywhere. This is why U.S. Treasury debt isn't just part of the financial system. It is the foundation it stands on. Let's clear a common misunderstanding. The total U.S. national debt is over $30 trillion. So why focus on $9.2 trillion? Because this portion represents U.S. Treasury securities held by major institutions, including commercial banks, the Federal Reserve, pension funds, insurance companies, foreign governments like China and Japan. This is the debt that sits directly on balance sheets. It is not abstract. It is not theoretical. It is active financial infrastructure. Banks use it as collateral. Governments use it as reserves. Corporations use it as safe storage. In modern finance, Treasury debt is money with a suit on. Why Treasury debt is called risk-free. U.S. Treasuries are often described as risk-free assets, and at first glance, that label sounds absolute, almost comforting. But it's important to understand what risk-free really means in this context, because it does not mean danger-free, consequence-free, or immune from loss. Instead, the term refers to a very narrow definition of risk, one that applies only to default. U.S. Treasury debt is considered risk-free primarily because the United States issues its debt in its own currency, the U.S. dollar. Unlike countries that borrow in foreign currencies and can run out of money, the U.S. government can always meet its obligations by issuing more dollars. Add to this the fact that the dollar is the world's dominant reserve currency, used in global trade, commodities pricing, and international reserves. This global demand creates constant appetite for U.S. Treasuries, reinforcing the belief that the U.S. will always be able to repay what it owes. In simple terms, the U.S. is unlikely to default in the traditional sense, which is why Treasuries are labeled credit risk-free. But this is where the illusion begins. While Treasuries may be protected from default, they are not protected from loss. The moment interest rates rise, the market value of existing Treasury bonds falls. Institutions holding long-term Treasuries can face massive unrealized losses on their balance sheets, even though the bonds themselves are still safe. This is known as interest rate risk, and it has repeatedly exposed vulnerabilities in banks and financial institutions during periods of rapid rate hikes. There is also inflation risk. If inflation rises faster than Treasury yields, the real purchasing power of the money returned to investors declines. In other words, you may get your dollars back, but those dollars may buy far less than expected. Over time, inflation silently erodes wealth, making safe assets dangerous for long-term holders. Finally, there is liquidity risk. In times of financial stress, even Treasury markets can seize up temporarily, forcing institutions to sell at unfavorable prices to raise cash. When these risks surface together, the damage doesn't stay isolated. It spreads through banks, markets, and entire economies. So while U.S. Treasuries are called risk-free, the truth is more complex. They are default-free, not consequence-free. And misunderstanding that difference has been the root of some of the biggest financial shocks in modern history. How banks are built on Treasury debt. Banks do not survive on deposits alone. Deposits can be withdrawn, transferred, or lost in moments of panic. What truly keeps banks alive is confidence. And confidence is built on collateral. In the modern financial system, no collateral is more important, more trusted, or more widely accepted than U.S. Treasury debt. Treasuries sit at the very center of banking operations, quietly supporting the system in ways most people never see. Banks rely on U.S. Treasuries to meet regulatory capital requirements, which are rules designed to ensure that banks can absorb losses and remain solvent during stress. Holding Treasuries signals safety to regulators because these assets are assumed to retain value and remain liquid. Beyond regulation, Treasuries allow banks to borrow short-term funds in money markets. A bank can pledge its Treasury holdings as collateral to access cash almost instantly, making them essential for daily operations. They also help banks manage liquidity, allowing institutions to move smoothly between surplus and shortage without disrupting the system. Simply holding Treasuries communicates stability, reassuring investors, counterparties, and customers that the bank is sound. But this foundation has a hidden weakness. When interest rates rise, the market value of existing Treasury bonds falls. Long-term bonds are especially vulnerable. On paper, a bank may appear healthy because those losses are often classified as unrealized. The bank hasn't sold the bonds, so technically, no loss has occurred. But in reality, the balance sheet has weakened. If the bank suddenly needs cash and must sell those bonds, the losses instantly become real. This is how assets labeled as safe quietly transform into systemic stress points. The danger doesn't come from Treasuries failing to pay. It comes from rate shocks. Rapid changes in interest rates that expose how tightly banks are tied to bond values. Treasuries rarely destroy banks on their own. But when interest rates move too fast, they reveal fragility hidden beneath the surface of stability. How corporations depend on Treasury debt. In the modern economy, U.S. Treasury yields act as the price of money. They are the silent reference point from which nearly every other interest rate is calculated. When Treasury yields move, the cost of borrowing across the entire economy moves with them. For corporations, this makes Treasury debt far more than a government concern. It becomes a direct influence on strategy, growth, and survival. Corporate borrowing costs are built on top of Treasury yields. Whether a company is issuing bonds, taking out loans, or refinancing existing debt, the interest rate it pays is almost always priced as Treasury yield plus a spread. As Treasury yields rise, that base cost increases automatically. This affects not just large corporations, but small and mid-sized businesses as well. Mortgage rates, which influence consumer spending and housing demand, also rise in response, creating second-order effects that ripple through corporate revenues. Higher yields force companies to rethink business expansion, delay capital projects, and become more cautious about hiring decisions. When Treasury yields rise sharply, the impact is immediate. Loans become more expensive, leverage becomes riskier, and investments that once made sense on paper no longer justify the cost of capital. As financing tightens, economic activity slows. Growth contracts not because businesses lack ideas, but because the price of money has risen beyond what those ideas can support. At the same time, corporations themselves are major participants in the Treasury market. Large firms often park billions of dollars in short-term Treasury bills as a safe place to store cash. These instruments offer liquidity, safety, and a modest return while companies wait to deploy capital. This means corporate balance sheets are directly exposed to government debt policy and interest rate decisions. When treasuries wobble, confidence weakens long before profits decline. Executives pull back, investors grow cautious, and expansion pauses. In this way, Treasury debt doesn't just influence corporations from the outside, it quietly shapes their behavior from within. Debt can help an economy grow, but only for a while. In the short term, it stabilizes countries, prevents deep recessions, and funds innovation. But over time, debt becomes a burden. Interest payments start swallowing public money, governments lose flexibility, and growth slows down. Today, the U.S. spends hundreds of billions every year just paying interest. Money that builds nothing, creates nothing, and employs no one. That is the hidden cost of too much debt. How this debt affects you personally. You don't need to buy a Treasury bond to feel the impact of U.S. government debt. It touches every corner of your financial life. Treasury debt quietly influences inflation, shaping the prices you pay for groceries, gas, and housing. It sets loan interest rates, determining how expensive your mortgage, car loan, or personal credit becomes. It even affects job stability, because higher Treasury yields can slow business expansion, pause hiring, or limit wage growth. And your retirement security is connected too. Most pension funds and insurance companies hold Treasuries to generate steady returns and maintain liquidity. Every government policy, from fiscal stimulus to social programs, is influenced by the structure and scale of Treasury debt. Every dollar the government prints, borrows, or inflates traces back to these bonds. Even if you're not actively investing, your financial future is built on a foundation of Treasury debt. It is the invisible thread linking government borrowing to your personal finances, shaping your purchasing power, the cost of money, and ultimately your standard of living. Why the world still trusts U.S. Treasuries. Despite the risks we've discussed, interest rate shocks, inflation, and liquidity challenges, the world continues to buy U.S. debt. The reason is simple. There is no alternative at scale. No other country offers the same combination of market depth, where trillions of dollars can be bought and sold without destabilizing the system. Legal stability, ensuring contracts and payments are enforceable. Currency dominance, giving global trust that these bonds will hold value. And military and political backing, reinforcing confidence that obligations will be met. This duality makes Treasuries unique. They are the safest risk and, simultaneously, the most dangerous dependency. The world relies on them for stability, yet that reliance creates a fragile interconnection. If confidence falters, the effects cascade globally. Markets tremble, loans tighten, and economies feel the shock. The Treasury debt is more than government borrowing. It is the foundation of modern finance, silently shaping economies, corporations, and even your daily life. What happens if U.S. Treasuries fail? Imagine waking up one morning to a world where the safest investment in the world isn't safe anymore. The very foundation of global finance, the $9.2 trillion in U.S. Treasury debt, has suddenly lost its credibility. Now, banks, pension funds, insurance companies, even foreign governments, all holding these bonds as risk-free assets, wake up to a nightmare. The value of trillions of dollars evaporates almost instantly. What was once collateral, what once stabilized loans and supported economies, is suddenly worth far less than anyone expected. Interest rates would skyrocket overnight. Mortgages, car loans, corporate borrowing, they would all become prohibitively expensive. Businesses would freeze expansion. Governments would struggle to fund even essential programs. And consumers? They'd feel it in every corner of their lives. Higher prices, limited credit, slower wages. Pension funds and insurance companies, the quiet guardians of retirement security, would see massive losses, threatening the financial future of millions. Retirement plans, college funds, and insurance guarantees would suddenly feel far less secure. And here's the part most people miss. The impact wouldn't stay in the U.S. Because treasuries are the global reserve asset, their failure would trigger a worldwide shockwave. Stock markets would tumble, currencies would wobble, and financial panic would spread from Tokyo to London to São Paulo. Every economy tied to the dollar would feel the tremors. In short, if U.S. Treasuries fail, it wouldn't just be a financial hiccup. It would be a systemic collapse, exposing just how fragile the global economy is when the world bets everything on confidence and trust in one single financial cornerstone. Confidence is fragile. Trust is priceless. And treasuries are the invisible thread holding it all together. Final thought. U.S. Treasury debt is more than government borrowing. It is confidence, power, and the foundation of modern finance. When trusted, it stabilizes the world. When shaken, it can ripple through every bank, every corporation, and even your personal finances. Understanding this is not optional. It is essential financial literacy in a world built on trust, numbers, and invisible chains of debt. The $9.2 trillion U.S. Treasury debt is not just a number. It is money, trust, power, stability, and vulnerability. If it holds, the system holds. If it fractures, the world feels it. And now you understand something most people never will. The global economy does not run on cash. It runs on confidence. And confidence lives inside U.S. Treasury debt.